What if Europe woke up tomorrow and the euro had never existed? Picture this. It's 2026. Germany is still printing Deutsche Marks. France guards its franc. Italy struggles with the lira's wild swings. Spain, Greece, and Portugal battle their own national currencies every single day. There is no single European money, no unified bond market, and no ECB acting as the continent's financial firefighter. Instead of one powerful currency binding 20 countries together, Europe remains a patchwork of competing monies, strong in the north, fragile in the south, constantly battling exchange rate chaos. In our world, the euro was supposed to make Europe unstoppable. It was meant to end currency wars forever and create a true economic superpower to rival America and China. But what if that never happened? What if the grand experiment of a single European currency had failed before it even began? Would Europe today be richer, poorer, stronger, or weaker? Would the continent be more stable, or constantly on the edge of currency wars and financial meltdowns? Stick with me, because in the next few minutes we're going to travel down the road not taken, the alternate history where the euro was never adopted and Europe chose sovereignty over unity. So where exactly did history split in this alternate timeline? The point of divergence comes in the early 1990s, right at the moment when Europe seemed closest to locking itself into a single currency forever. It all begins with the Maastricht Treaty, signed in 1992. This ambitious agreement was supposed to lay the foundation for economic and monetary union. It set strict rules. Countries had to keep budget deficits below 3% of GDP, public debt under 60%, and bring their inflation and interest rates into line. Only then could they move toward a shared currency. But the treaty hit an unexpected wall almost immediately. In June 1992, Danish voters went to the polls and narrowly rejected Maastricht by 50.7% to 49.3%. They feared losing too much sovereignty and handing control of their economy to distant bureaucrats in Brussels. In our real history, Europe managed to patch things up with special opt-outs for Denmark and pushed forward. But in this alternate timeline, that narrow Danish no creates a powerful domino effect. The backlash spreads quickly. Just months later, in September 1992, the European exchange rate mechanism, the system designed to keep European currencies tightly pegged together, explodes in crisis. Britain is forced out on Black Wednesday after spending billions trying to defend the pound. Italy and others face massive speculative attacks. Exchange rates swing wildly, exposing just how fragile the whole setup really is. Public confidence collapses. In France, the narrow PTOUI in their own Maastricht referendum flips under pressure. Voters, rattled by the currency chaos and high unemployment, say no. Meanwhile, Germany's powerful Bundesbank watches all this with deep skepticism. German reunification after the fall of the Berlin Wall has already brought huge spending and inflationary pressures. The Bundesbank, fiercely protective of the strong Deutsche Mark, insists that the convergence criteria must be applied strictly. No shortcuts, no political fudging. They argue that Europe simply lacks the labor mobility, wage flexibility, and fiscal discipline needed for a successful currency union. Without those foundations, they warn, a single currency would become a disaster waiting to happen. With key countries backing away and Germany refusing to compromise, the political momentum evaporates. The planned launch of the euro in 1999 never occurs. Stage 3 of monetary union is quietly shelved. Europe keeps its national currencies and sticks with loose, ultimately failing attempts at managed exchange rates. This was never inevitable. It was the result of real political pressures, economic shocks, and honest disagreements about whether Europe was truly ready to give up the powerful tool of devaluation. But once that window closed, the path forward changed forever. Instead of marching toward one currency, Europe remained a continent of many monies, each nation retaining the ability to adjust its own interest rates and exchange rates when shocks hit. That single decision, or rather that failure to decide, set the stage for everything that followed. With the Euro project dead, Europe stepped into the new millennium still operating as a continent of many currencies. The immediate years after 1999 brought a return to the kind of economic realities that the single currency had promised to eliminate forever. Exchange rates between European nations, once locked tightly together in the old exchange rate mechanism, now floated more freely again. The Deutsche Mark strengthened as Germany's economy powered ahead after reunification. The French franc held relatively steady, but the Italian lira, the Spanish peseta, and the Greek drachma faced repeated pressure and volatility. Traders and businesses woke up every morning not knowing exactly what their cross-border deals would be worth by afternoon. Hedging costs rose, transaction fees returned, and the old familiar friction of currency conversion crept back into everyday commerce. Trade between European countries suffered as a direct result. In our timeline, the euro is estimated to have boosted intra-European trade by somewhere between 5 and 10% by removing exchange rate risk and lowering costs. Hey, that boost never materialized. Companies had to spend more on currency hedges and faced greater uncertainty when planning investments across borders. Small and medium-sized firms, in particular, found it harder to expand into neighboring markets. What should have been a seamless single market suddenly felt a little less single and a little more fragmented. Politically, tensions simmered beneath the surface. Without the euro as a powerful symbol of unity and a practical tool for deeper integration, the European Commission lost some of its leverage. Countries guarded their monetary sovereignty more jealously. Germany, with its strong Deutsche Mark and independent Bundesbank, felt less pressure to subsidize weaker partners through implicit transfers. France pushed for more coordinated industrial policies, but without a shared currency, coordination proved difficult. Southern European nations, facing higher borrowing costs because investors now demanded a clear risk premium for lending in potentially devaluable currencies, began to resent what they saw as northern dominance. Financial markets reacted swiftly. Investors demanded higher interest rates from countries with weaker currencies and larger deficits. Capital flowed more readily toward the hard currency North, Germany, the Netherlands, Austria, while southern economies experienced more volatile inflows and outflows. The absence of a single euro bond market meant there was no deep, liquid European capital market to absorb shocks. Instead, each national bond market stood on its own, with yields diverging more sharply whenever confidence wavered. In our timeline, the launch of the euro created a sense of inevitability about European unity. Hey, that sense evaporated. The early 2000s saw more frequent disputes over trade imbalances, competitive devaluations, and accusations that one country or another was unfairly manipulating its currency to gain export advantage. The old ghosts of 1990s currency crises never fully disappeared. They lingered as a reminder that monetary union had been postponed, perhaps indefinitely. Yet this fragmentation also brought a certain flexibility. When a country faced a specific economic shock, say, an export slump in Italy or a tourism dip in Spain, its central bank could adjust interest rates or allow its currency to depreciate without needing permission from a supranational authority. That tool of national monetary policy, surrendered in our world, remained available here. For some nations, it proved a useful safety valve in the short term. By 2004, Europe looked economically messier than it did in our timeline, but also more sovereign. The grand dream of one money for one continent had given way to a more traditional balance of competing national interests. And the stage was now set for the bigger tests that lay ahead in the decade to come. As the years rolled from the early 2000s into the next decade and beyond, the consequences of Europe's decision to keep its national currencies became deeper and more structural. What began as short-term volatility evolved into a lasting pattern of economic and political fragmentation that reshaped the continent. Without the euro acting as a powerful symbol and practical glue, the momentum for deeper European integration slowed noticeably. The European Union continued to function as a large single market for goods and services, but the drive toward ever closer union lost steam. Enlargement to the east still happened, but it proceeded more cautiously and on different terms. New member states from Central and Eastern Europe negotiated bilateral trade and monetary arrangements rather than rushing toward a shared currency club that no longer existed. The promise of joining a strong, unified monetary bloc was no longer on the table, so accession talks focused more heavily on fiscal discipline and structural reforms without the automatic prestige of euro adoption. The big economies carved out clearer roles in this more traditional European order. Germany, anchored by its strong and credible Deutsche Mark and the independent Bundesbank, reinforced its position as the continent's economic powerhouse. German policymakers could pursue monetary policy focused tightly on domestic price stability without the pressure of managing divergent needs across the south. France, meanwhile, used the flexibility of the franc to support its industrial ambitions, occasionally allowing competitive adjustments to protect key export sectors. The United Kingdom, which had always kept the pound outside any rigid system, found itself in a relatively advantageous spot. London's financial markets positioned the pound as a safe haven alternative amid the patchwork of continental currencies, attracting capital that might otherwise have flowed into a deeper euro area bond market. Over time, distinct regional currency blocks began to emerge. A northern hard currency group, Germany, the Netherlands, Austria, and a few others, maintained relatively stable and strong exchange rates among themselves through informal coordination. In contrast, southern economies with the Lira, peseta, and drachma experienced more frequent fluctuations and occasional devaluations to restore competitiveness after shocks. This created a visible north-south divide in borrowing costs and investment flows. Investors demanded higher risk premiums from countries whose currencies could weaken, leading to persistently higher interest rates in the periphery compared to the core. Because Europe lacked the trade creation boost that the euro delivered in our timeline, studies suggest that boost was in the range of 5 to 10% for intra-European commerce. Cross-border business activity grew more slowly. Companies faced ongoing exchange rate uncertainty and hedging expenses that a single currency would have eliminated. As a result, economic divergence widened. When asymmetric shocks hit, a construction boom in Spain, an export slowdown in Italy, or a manufacturing dip in France, there was no common monetary policy to cushion the blow. Countries relied instead on their own interest rates and exchange rate adjustments, which sometimes helped recovery but often fueled political friction and accusations of beggar-thy-neighbor policies. By the late 2010s, Europe looked noticeably different from the more unified bloc we know today. The EU remained an important framework for trade rules and regulation, but it felt less like an emerging political union and more like a sophisticated free trade area with sovereign monetary policies. National governments retained greater control over their economic destinies, which brought both flexibility and the constant risk of renewed currency tensions. The grand vision of one continent, one economy, one money had given way to a more pragmatic, if messier, balance of competing national interests. This period of medium-term adjustment set the stage for how Europe would navigate the major global crises that were still to come. The absence of a single currency did not prevent shocks, but it changed how those shocks spread, and how individual countries could respond. The decision to keep national currencies in Europe did not just reshape the continent. It sent ripples across the entire global financial system and altered the balance of economic power worldwide. Without a single, credible euro to challenge the dollar, American currency dominance remained stronger for longer. In our timeline, the euro quickly became the world's second most important reserve currency, holding around 20% of global foreign exchange reserves and providing a real alternative for central banks and investors seeking diversification. Hey, that alternative never fully materialized. The dollar's share stayed higher, closer to its pre-euro levels for an extended period, because there was no unified European bond market deep enough or liquid enough to compete on the global stage. Countries around the world continued to hold more dollars for trade, reserves, and safe haven purposes, giving the United States greater freedom to run deficits and conduct monetary policy without facing the same external pressures. This prolonged dollar strength had mixed consequences. On one hand, it reinforced America's ability to finance itself cheaply and project financial influence. On the other, it may have delayed the kind of gradual multipolar adjustment we have seen in recent years. Emerging markets and commodity exporters, facing higher risks when dealing with Europe's patchwork of currencies, often preferred to invoice and settle trade in dollars rather than take bets on fluctuating Deutsche Marks, Lira, or Francs. The result was a more dollar-centric global trading system than the one that developed with a single euro. At the same time, the absence of a unified European monetary voice encouraged other players to step forward earlier. China accelerated its efforts to internationalize the renminbi, pushing bilateral currency swaps and promoting yuan usage in trade with Asia, Africa, and Latin America. Without a strong euro bloc acting as a counterweight in global forums, Asian economies deepened their own regional financial arrangements. Japan and South Korea, for instance, expanded yen and won-based financing networks, while Southeast Asian nations explored tighter coordination within ASEAN. The world's financial architecture became less bipolar, dollar versus euro, and more fragmented into overlapping currency spheres. Europe itself paid a price in global influence. A continent divided monetarily found it harder to speak with one voice on international economic issues. Trade negotiations with the United States or rising Asian powers became more complex, as each European country brought its own currency concerns to the table. European banks and corporations faced higher costs when operating globally because they lacked the scale and stability that a single currency provided in our timeline. Over time, Europe's share of global GDP and financial market activity grew more slowly than it might have with the integration boost the euro delivered. Second-order effects emerged in surprising places. Global liquidity became more uneven during stress periods, as national European central banks pursued independent policies rather than a coordinated response through the ECB. This fragmentation sometimes amplified shocks in emerging markets that relied on European capital flows. Meanwhile, stronger national monetary sovereignty in Europe allowed some countries to respond more flexibly to global commodity price swings or technological shifts, but at the cost of duplicated efforts and occasional intra-European currency tensions spilling over into trade disputes. By the late 2010s, the global economy looked noticeably different: a still dominant but perhaps overextended dollar, a rising but regionally focused renminbi, and a Europe that was economically pragmatic yet geopolitically less cohesive. The grand hope of the euro as a pillar of a multipolar world order never materialized. In its place stood a more traditional system where national currencies reflected national power, and the world adjusted accordingly. These global shifts would prove critical when the next major crises arrived, testing whether Europe's choice of flexibility over unity was a source of resilience or vulnerability. When the global financial storm of 2008 hit, Europe in this alternate timeline faced many of the same underlying vulnerabilities that plagued the real world: housing bubbles in Spain, banking overexposure in Ireland, and large current account deficits in southern countries. But without the euro, the way those shocks played out looked very different. The European debt crisis that erupted around 2010 still occurred, driven by the same buildup of private and public debt during the good years. However, it unfolded with greater short-term pain but potentially faster national adjustments. In our timeline, countries locked into the euro could not devalue their currency to regain competitiveness, forcing them into harsh internal devaluation through wage cuts, unemployment, and prolonged austerity. Nations still using the lira, peseta, or drachma had the option to let their currencies weaken. Italy or Greece could see their exchange rates fall, making exports cheaper and imports more expensive almost overnight. This restored competitiveness more quickly for some economies, shortening the depth of recession even if it came with higher inflation and imported pain for households. That flexibility came at a cost. Without a single European central bank ready to buy sovereign bonds on a massive scale, borrowing costs for weaker countries spiked higher and faster. Investors demanded even larger risk premiums, fearing outright default or repeated devaluations. Bailouts, when they happened, were more bilateral and ad hoc. Germany might lend directly to a struggling partner, but with stricter conditions and less pooling of risk. The dreaded sovereign bank doom loop still appeared in places, but it played out country by country rather than across an interconnected euro area banking system. Some analysts argue this might have prevented the crisis from threatening the entire monetary union survival, since there was no single currency to potentially break up. The 2008 financial crisis itself also diverged in important ways. National central banks could tailor their responses more precisely. Germany's Bundesbank might tighten policy earlier to guard against inflation, while Spain or Portugal eased aggressively to support domestic demand. This avoided the one-size-fits-all monetary policy that critics say worsened divergences inside the Eurozone. Yet it also opened the door to competitive devaluations, countries deliberately weakening their currencies to boost exports at their neighbors' expense. Echoes of the currency wars of the 1930s returned, with accusations flying across borders and occasional trade tensions flaring up inside the European single market. These currency adjustments acted as automatic stabilizers for asymmetric shocks, something optimal currency area theory suggests a fragmented Europe would rely upon. But they also created second-order problems. Volatile exchange rates made long-term investment planning harder, slowed cross-border supply chains, and fueled political resentment when one country's devaluation hurt another's exporters. Populist movements gained ground earlier in several nations, blaming neighbors for unfair monetary manipulation rather than distant Brussels bureaucrats. In the end, the crises of 2008 and 2010 tested Europe's choice of sovereignty over unity. In our timeline, the euro forced painful internal adjustments but preserved a symbolic and institutional commitment to integration, with the ECB eventually stepping in as lender of last resort. National tools allowed quicker rebounds in some places, but at the price of deeper short-term market panic, fragmented responses, and renewed inter-European rivalries. The crises did not destroy the European project, but they exposed its limits more starkly, proving that monetary fragmentation brought both valuable flexibility and dangerous instability when the world economy trembled. These experiences would echo for years, shaping how Europe approached global challenges and internal reforms in the decade that followed. So who ultimately won and who lost in this alternate Europe without the euro? The answer reveals a complex balance sheet of power, flexibility, and long-term trade-offs. Germany clearly emerged as one of the biggest strategic winners. With full control over the Deutsche Mark and the Bundesbank's hawkish focus on price stability, Germany avoided the massive implicit transfers and target to imbalances that built up in our timeline. It could run a tight monetary policy suited to its export-driven economy, without being dragged into supporting weaker partners through a shared central bank. German industry benefited from a consistently strong and credible currency that reinforced its reputation for reliability in global markets. The Netherlands, Austria, and other northern economies largely shared in this advantage, enjoying lower borrowing costs and greater monetary independence. On the other side, southern and peripheral countries faced a more difficult position. Italy, Spain, Greece, and Portugal paid higher risk premiums on their debt because investors constantly worried about potential devaluations or fiscal slippage. Without the credibility boost and lower interest rates that the euro provided in our timeline, these nations sometimes struggled to finance themselves affordably. Small open economies found it harder to attract stable foreign investment when exchange rate volatility added an extra layer of risk. However, when shocks hit, they could still use currency depreciation as a pressure valve, allowing faster recovery and competitiveness than the long years of internal austerity seen in the real Eurozone crisis. The United Kingdom gained a surprising edge. The pound became an attractive safe haven currency amid continental fragmentation, helping London strengthen its position as a leading international financial centre. British policymakers enjoyed greater freedom to set interest rates independently, sometimes positioning the UK as a pragmatic middle ground between a strong northern bloc and more volatile southern economies. For European institutions, the picture was less favourable. The European Commission and the broader EU project lost significant leverage without the euro as both carrot and stick for deeper integration. Supranational power remained more limited, forcing Brussels to rely on persuasion rather than the gravitational pull of monetary union. National governments, by contrast, retained real sovereignty over their most powerful economic tool, money itself. Looking at industries, export-oriented manufacturers in competitive northern economies thrived under stable hard currencies, while tourism, agriculture, and domestic-focused sectors in the south sometimes benefited from occasional devaluations that made their offerings cheaper for foreign buyers. Global investors and multinational corporations, however, faced higher costs and complexity operating across multiple European currencies, leading some to favor Asian or North American supply chains instead. At its core, this alternate history forced a clear trade-off between stability and sovereignty. A single currency had promised greater shock absorption and lower transaction costs across the continent, but at the price of one-size-fits-all policies that often ignored national differences. Keeping national currencies preserved policy flexibility and democratic accountability over monetary decisions, yet it came with persistent exchange rate volatility, duplicated efforts, and the risk of renewed currency conflicts. Europe became more adaptable in responding to local shocks, but less capable of presenting a united economic front to the rest of the world. Power shifted noticeably within the continent. Germany's economic weight translated more directly into monetary influence, while France's traditional push for political leadership sometimes clashed with a more fragmented economic reality. The old Franco-German motor of integration continued, but it ran on more traditional balance of power logic rather than shared institutions. In the end, this Europe was neither a clear success nor outright failure. It was a more sovereign, more diverse, and in some ways more realistic reflection of the continent's deep underlying differences. The choice to reject a premature currency union delivered genuine flexibility, but it also meant living with the constant friction and uncertainty that comes when nations insist on keeping control over their own money. These strategic realities would continue to influence how Europe positioned itself in an increasingly competitive global order. To truly understand why the euro never happened in this timeline, we need to step back from the events and examine the deeper theories that explain what unfolded. From a realist perspective in international relations, the failure was almost inevitable. Realists argue that states are fundamentally driven by the pursuit of power and survival in an anarchic world. They prioritize relative gains over absolute cooperation. In this view, giving up control of your national currency means surrendering a vital tool of economic statecraft, the ability to devalue, adjust interest rates, or protect domestic industries during crises. Countries like Germany, protective of the Deutsche Mark's strength, and southern states wary of losing the devaluation option, simply refused to cede that sovereignty. The Euro project collapsed because deeper integration threatened national power and autonomy. What looked like a technical economic decision was, at heart, a classic struggle over who controls the levers of economic policy. Realism sees Europe's fragmented outcome not as a mistake, but as the natural return to balance of power politics once the idealistic push for union lost momentum. Liberals, by contrast, offer a more optimistic but ultimately disappointed interpretation. They emphasize the role of institutions in overcoming selfish state interests and fostering long-term cooperation. In their view, the Maastricht Treaty and the planned European Central Bank represented a remarkable attempt to build supranational institutions that could deliver peace and prosperity through shared rules. The failure here was not inevitable but the result of short-sighted domestic politics, poor timing, and insufficient political will to complete the necessary fiscal and political union alongside monetary union. Liberals point out that well-designed institutions could have gradually built trust and delivered mutual gains. Instead, the collapse of the Euro project showed how fragile liberal cooperation can be when domestic veto players, voters in referendums, skeptical central bankers, and nationalist politicians push back against ceding sovereignty. Game theory provides perhaps the clearest lens for what actually happened. The situation resembled a prisoner's dilemma on a continental scale. Each European nation had a choice: cooperate by strictly following convergence criteria and eventually surrendering monetary control, or defect by protecting its own currency and policy flexibility. If everyone cooperated, the whole continent might have gained from deeper integration and reduced transaction costs. But the dominant strategy for each individual country was to defect, to keep the powerful tool of exchange rate adjustment in reserve for when times got tough. Because no country could trust the others to stay committed long-term, especially after the exchange rate mechanism crises exposed deep asymmetries, the rational outcome was the fragmented Nash equilibrium we see in this timeline. Everyone keeping their own currency rather than risking a union that might collapse painfully later. This brings us to one of the most influential ideas in economics, optimal currency area theory, first developed by Robert Mundell in 1961. According to this framework, a currency union makes sense only if the participating regions experience similar economic shocks, have high labor mobility, flexible wages, and the ability to share fiscal risks through transfers. Europe, even in the 1990s, fell short on several of these criteria. Shocks were often asymmetric: a tech boom in the north, a tourism slump in the south. Labor mobility across languages and cultures remained limited. Without a large central budget for fiscal transfers, countries in trouble had few shock absorbers. Two competing interpretations have long divided economists on this point. Some believe that currency unions can become optimal over time through endogenous effects. The very act of sharing a currency encourages deeper integration, trade, and synchronization. Others, citing early studies by economists like Bayemi and Eichengreen, argued that Europe's structural differences were too deep and permanent for a successful union without major political changes that never materialized. In this alternate history, the structural skeptics proved closer to the mark. The prisoner's dilemma played out, realist power calculations dominated, and the liberal institutional project fell short. Europe chose the safer, more sovereign path of fragmentation over the high-risk gamble of unity. Whether that was ultimately wise or short-sighted remains one of the great counterfactual debates in modern political economy. These theoretical lenses help explain not just why the euro failed to launch, but why its absence produced a particular mix of flexibility and friction that defined this alternate Europe for decades afterward. As we reach the end of this journey through an alternate history where the euro was never adopted, what have we learned? In this timeline, Europe preserved something precious: genuine monetary sovereignty. Each nation retained the ability to adjust its own interest rates and allow its currency to find its own level when economic shocks arrived. This flexibility helped some countries recover competitiveness more quickly during the crises of 2008 and 2010, avoiding the longest and harshest years of internal austerity that marked the real Eurozone experience. Germany strengthened its position as an economic anchor with a trusted Deutsche Mark, while the European Union evolved into a more pragmatic trading bloc rather than a quasi-federation. Yet this choice came with real costs. Persistent exchange rate volatility raised transaction costs and slowed the growth of intra-European trade. Borrowing costs remained higher for weaker economies. Europe spoke with a more divided voice on the global stage, allowing the US dollar to maintain stronger dominance and giving China and Asian economies more room to build their own financial networks earlier. The continent became economically messier, more diverse in outcomes, and less unified in its projection of power. The absence of the euro did not prevent crises, but it changed how they were absorbed. It traded the dream of seamless stability for the reality of national accountability and policy flexibility. In many ways, this alternate Europe was a more honest reflection of the continent's deep economic, cultural, and political differences that a single currency could paper over but never fully erase. So let's return to the central question we asked at the beginning. What if the euro had never been adopted? Would Europe be better or worse off today? The honest answer is that it would be different. Stronger in sovereignty, perhaps more resilient in responding to asymmetric shocks, but weaker in scale, influence, and the quiet efficiency that a common currency can provide. The euro was never an inevitable triumph of progress. It was always a high-stakes political and economic gamble, one that bet heavily on unity overcoming deep structural divergences. In our real world, Europe took that gamble. In this alternate timeline, it stepped back and chose caution. Whether that was the wiser choice remains fiercely debated by economists and historians. But one thing is clear: money is power. The decision to keep national currencies reminded the world that even in an age of globalization, states are often unwilling to surrender the most fundamental tools of economic self-determination. A continent of many currencies, or a currency without a true continent behind it. The road not taken still whispers an important truth. Sometimes the boldest visions of unity must confront the stubborn realities of diversity. And in the end, Europe, fragmented or united, must always live with the consequences of that tension. Thanks for watching. If you enjoyed this deep dive into alternate history and speculative geopolitics, leave a like. Share your thoughts in the comments. Would you rather have a strong single currency or keep national monetary sovereignty? And subscribe for more thought-provoking explorations of the roads not taken in global affairs.